The gap you're entering is probably the wrong gap. I lost money here. Don't make the same mistake I did. Everyone enters at 50% of the fair value gap. Fine, but the 50% is the least important number in the whole setup. Most of the gaps on your chart shouldn't be on your chart at all. And if you're entering those, no entry rule on earth is going to save you. So today, I'm not going to hand you an entry and send you off. I'm going to hand you the 3 conditions a gap has to pass before I'll even draw the box. Here's what I mean by that. A gap on its own tells you almost nothing. It tells you price moved quickly. That's it. That's the whole message. Price moves quickly all the time on a data print, on a stray headline, on a thin Asian session where nobody's watching. None of that gives the market a reason to walk back to that area and do business there. The gaps worth trading aren't the fast ones. They're the ones that broke something on the way through. What you'll be able to do by the end? 3 things. 1. Read a structure well enough to know, in about 10 seconds, who's actually in control of the chart in front of you. 2. Filter gaps down from the 20 on your screen to the one that's worth an order. 3. Place an entry, a stop, and a target off that gap without asking anyone's opinion, including mine. And I'll say the quiet part now, this isn't a strategy you'll be good at on Monday. It's a strategy you'll be good at in about 6 weeks, and I'll give you the drill at the end that gets you there. And one thing I want you to hold on to, because I'll come back to it. At some point, price is going to walk into your beautiful gap and keep right on walking. Everyone shows you the version where it bounces. Nobody shows you the other one. I've got a rule for that one line, mechanical, no interpretation, and it's the single thing that took this setup from break-even to worth trading for me. It's coming, about 2/3 of the way through. Don't skip to it, because it won't make sense without the filter first. Structure is the least glamorous part of this, and it's the part that does the work. Price doesn't drift randomly. It pushes, it pulls back, it pushes again. And that pattern of highs and lows is the only honest record you have of who's winning. In an uptrend, you get higher highs and higher lows. Every time price closes above the previous high, that's a break of structure buyers took ground and kept it. 3 breaks in a row, and I don't need an indicator to tell me the trend is up. I can see it. Now, the part that actually pays. In that same uptrend, watch the higher lows, not the highs. As long as each pullback stops above the last one, nothing has changed, and I'm not interested in shorts. The moment price closes below the most recent higher low, that's it. That's the change of character. The rule that defined the trend just broke. It doesn't mean the market is now bearish. It means the people who were in control have lost it, and until somebody retakes it, that chart is a different chart. And keep this straight. A change of character on the 1 minute is a 1-minute event. It is not a signal that the daily trend has turned. Match the time frame of the signal to the time frame of the conclusion, and you'll avoid half the mistakes in this space. What a fair value gap actually is. 3 candles, that's the whole definition. Take any 3 candles in a row on a chart. If the market is moving up, and the high of the first candle sits below the low of the third candle, there's a space between them that no candle body ever traded through. That space is your bullish gap. Flip it for a bearish one. The low of the first candle sits above the high of the third, and the space in between is your bearish gap. Middle candle did all the work. First and third just mark the edges. Now, why does anyone care about an empty box on a chart? The honest answer isn't mystical. In that middle candle, one side of the auction basically stopped showing up. Buyers kept lifting every offer in front of them, and there weren't enough sellers at those prices to slow it down, so the price skipped a whole band of levels without a proper argument. Nobody agreed on what that area was worth. The market just ran through it on its way somewhere. And here's the part you'll hear the opposite of everywhere. A gap is not a high-volume area. It's the least traded area on that stretch of chart. Which is why price so often comes back not because the gap is calling it, but because the move ran out of steam and the only place left to find a counterparty is the band it skipped. I want to be straight with you about the evidence here, because I'd rather you trust me on the small things than oversell you on the big ones. This is a reasonable read of order flow. It is not a law of physics, and you'll find no shortage of channels quoting hit rates for gap fills with nothing behind the number. Don't take mine either. What you can do is check it yourself on your own pair over your own sessions, which is exactly what the drill at the end is for. To filter 3 conditions before I draw the box. Condition 1, and it's the big one. The gap has to be the one that broke structure, not near the break, not on the same chart as the break. It has to be inside the leg that closed price through the level. If the candle that did the damage is the same candle that left the gap, that gap has a story. Someone was in enough of a hurry to take out a structural level and leave money on the table doing it. Every other gap on your chart is just a fast candle. Condition 2. It has to be untouched. Once price has traded back into a gap and left again, the unfinished business is finished. Somebody found their counterparty. Going back a third and fourth time is just a level at that point, and levels are a different lesson. One touch, one trade, then the box comes off my chart. I delete it. Genuinely delete it, because a chart covered in dead boxes is how you end up talking yourself into a trade at 4 in the afternoon. Condition 3. It has to be somewhere the higher time frame cares about. If my 15-minute chart says the last 3 hours have been a slow grind up into a level that's rejected price twice already this week, I'm not buying a 1-minute gap underneath it. Great gap, terrible neighborhood. The gap gives you the entry. The 15-minute gives you permission. If you only take one thing from this section, take that sentence. The map the 15-minute before London opens. My chart is on GBP USD, and my clock is on London. 8 in the morning UK time, the London session opens, volume arrives, and sterling stops behaving like it did overnight. That's my first window. My second is 2:30 in the afternoon UK time, when New York opens and gold usually decides what kind of day it's going to be. Everything outside those 2 windows, I mostly leave alone. Not because nothing happens, because I don't want to be the most enthusiastic person in a quiet room. Before the open, I want 2 or 3 days of 15-minute candles on screen, not more. I'm not doing archaeology. I'm asking one question. Which way has this thing been leaning? And where did it leave from? So I mark my breaks of structure, I mark the most recent change of character if there is one, and I mark any 15-minute gaps that are still untouched. 3 tools: a trend line, a rectangle, and the discipline to stop after that, and then stop. If your 15-minute has 14 boxes, 6 trend lines, and a Fibonacci on it, you haven't analyzed the market, you've decorated it. The entry model 5 steps, no interpretation. Now the 1 minute. Step 1. I wait for a change of character in the direction my map allows. Price has been sliding, it makes a low, and then it closes above the most recent lower high. That's my signal that the sellers who were running the last 20 minutes have just lost the argument. Nothing before that close is a signal. It's a hope. Step 2. I look inside the leg that just did that. Not before it, not after it, inside it. If that leg left a gap, I've got a candidate. If it didn't, if price crawled up through the level, candle by candle, with everything overlapping, then there's no gap, there's no trade, and I go and make a coffee. This happens far more often than the trade does, and getting comfortable with that is most of the job. Step 3. The order. I take the top and the bottom of that gap, I split it in half, and my limit sits at the midpoint, not at the top edge, where you're paying up to be early, not at the bottom edge, where you're asking the market to do you a favor. The middle is the honest compromise between getting filled and getting a decent price, and this matters. It's a rule, so I can't negotiate with myself about it at 8:30 in the morning. Step 4. The stop. It goes below the low that started the whole move, the low that price made before the change of character, not below the gap, not a fixed 10 pips because 10 is a round number. Below the low, because if price goes back and takes out that low, the change of character was a lie and I've got no business being it along. The stop isn't a budget. It's the price at which my reason for being in the trade has stopped existing. Step 5. The target. First one goes at the most recent structural high. The level price has to clear anyway if this is going anywhere. Second one goes at the next 15-minute level from my map. And that's the order. Entry, stop, target. All three decided before I'm filled. All three visible on the chart. None of them up for discussion once price starts moving. If you can only build a discipline for one habit this year, make it that one. The invalidation rule, a wick is a test, a close is a verdict. Write the thing I promised you. Price walks into your gap and doesn't bounce. Here's the rule, and it's one line. A wick through the gap is a test. A close through the far side of the gap is a verdict. If a 1-minute candle closes below the low of a bullish gap, that gap is dead. Not discounted, not deeper value, dead. Cancel the limit if you're not filled, and if you are filled, you're not waiting for your stop to be polite about it. Why does that one line matter so much? Because without it, every losing gap trade turns into an averaging problem. Price closes through, you tell yourself the zone extends a bit lower, you add, and now you're not in a trade, you're in an argument with the market about who's right, and you're the one paying rent on the position. The rule doesn't make you money, it just stops one bad trade from becoming a bad week. And the flip side, which nobody says out loud, when the gap does hold, it usually holds fast. You're not sitting in a bullish gap for 40 minutes wondering. Either the reaction is there within a few candles, or the premise was wrong. Time is information in this setup. If it's been 15 minutes and price is still sitting inside her box doing nothing, the urgency that created the gap has gone home, and so should you. Walk through GBP USD at the London Open. Let me put the whole thing together with numbers. GBP USD, London Open. My map says the 15-minute has been grinding up for 2 days. 3 breaks of structure, no change of character buyers in control. So I'm hunting longs, and I'm not allowed to short. 8 o'clock arrives, and the first thing price does is drop. Which is exactly what you'd expect, and exactly what makes people abandon their own plan. Price slides down to 1.2706 and stalls. Then, a 1-minute candle closes above 1.2733, which was the last lower high of that slide. There's my change of character. I look inside that leg. The candle that broke 1.273. 3 was a big one, and it left a gap between 1.271, 2 and 1.272, 6. So, it broke structure, tick. It's untouched, tick. And it's sitting above a 15-minute area my map already liked, tick. 3 for 3. That's a trade. Midpoint of 1.2712 and 1.2726 is 1.2719. That's my limit. My stop goes below 1.2706. Call it 1.2704, giving the low a couple of pips of room, which makes my risk 15 pips. First target is the structural high the move has to clear anyway, and the second is the next 15-minute level up at 1.2775. 15 pips of risk, 56 pips to the second target. All 4 numbers are on the chart before the pullback even starts. Price pulls back, taps 1.2719, fills me, and I do absolutely nothing for the next 11 minutes. That's the part I can't teach you in a video, and it's the part that decides everything. The trade either works or it doesn't, and my job finished the moment the orders were in. On this one, it worked. But I want to be very clear that I'm walking you through the mechanics here, not selling you a highlight. The identical setup fails regularly, and it fails in exactly the same shape. Same model, different animal Xauusd at the New York Open. Half 2 in the afternoon UK time, gold. Same 5 steps. And I want you to notice that literally nothing about the model changes, only the numbers get bigger and meaner. Gold sells off into 2,338. Then a 1-minute candle closes above the last lower high at 2,344. The breaking leg leaves a gap between 2,341 and 2,347. Midpoint, 2,344. Stop below the low at 2,336. So $8 of risk. Now the honest bit that separates gold from cable. $8 of risk on gold is a normal-looking stop and an unforgiving one. Spreads widen at the New York Open. The first push often runs both ways before it picks one, and a stop that would be comfortable on GBP/USD is a coin flip on gold. Same model, different animal. If you're learning this, learn it on the pair that moves slower and earn your way onto gold. There's no prize for starting on the hard one. The risk-reward question why fixed 1 to 4 isn't free. You'll hear that at 4 to 1 you only need to win a quarter of your trades. The maths is close. At 4 to 1 you break even at a 20% hit rate, 1 in 5. That sounds gloriously easy right up until you live it. At a 30% win rate, which is a perfectly healthy number for this kind of setup, the odds of losing 5 in a row are about 17%, not once in your life. Roughly 1 run in 6. 8 losses in a row at that same win rate comes in around 6%. 6% isn't rare. Take 100 trades this year, and you will meet that streak. Not might, will. So when you're deciding whether to risk 1% or 3%, you're not really choosing a return. You're choosing whether the streak that is definitely coming leaves you with an account or with a story. Which is why I don't run a fixed 4 to 1 and pretend it's a strategy. I take the target structure gives me. Sometimes that's 2 to 1 because the next 15-minute level is close and I'd rather have the 2 than invent the 4. A 4 to 1 that requires the market to do something it has no history of doing at that time of day isn't a 4 to 1. It's a 1 to 1 with extra steps and a screenshot. Sizing leverage is a margin number, not a risk number. This is the part people get wrong in the most expensive way. So let's do it slowly with our GBP/USD trade. £500 account. 1% risk is £5. My stop is 15 pips, which is 0.0015 of price. 5 divided by 0.0015 gives me about 3,1/3,000 units. Call it 3 micro lots. That's the position. Not a feeling, not a slider, not what the platform suggests. 1 division. Now, leverage. And I want to kill a myth here. That position is worth about £4,200 of exposure. You obviously don't have that sitting in a £500 account, and you don't need it. Leverage means the broker only asks you for margin. Under the FCA's rules that came in with Piece 19 over 18, a UK retail account is capped at 30 to 1 on major pairs, so your margin here is roughly £140. Here's the bit that matters. Turning your leverage up from 30 to 1 to 200 to 1 does not change your risk by a single penny. Your risk was set the moment you chose 15 pips and 3 micro lots. Leverage only changes how much cash the broker parks aside. Every account I've seen blown up was blown up by position size, wearing a leverage costume. Someone raised the leverage, felt richer, and quietly raised the lots to match. And one practical trap while we're here, because it's the reason half of you can't trade the gold example. $8 of stop on gold, 1% of 500, means you'd want about 6/100ths of a lot. Most brokers won't go below 1/100th, which is 1 ounce, and 1 ounce with an $8 stop is about 1.5% of that account before spread. So the account size chose the instrument for you. That's not a strategy problem, it's arithmetic, and it's better to meet it here than at the open. The days I don't trade this. 4 of them. 1. High impact data inside my window. If there's a UK inflation print at 7:30 or a US number at 1:30, the 8 o'clock and 2:30 structure isn't structure, it's positioning. And gaps created by a data release are noise wearing a costume. I checked the calendar the night before. It takes 40 seconds, and it's the highest return 40 seconds in my week. 2. When the 15-minute has no structure to break. Some mornings, sterling has spent all night in a 20-pip box, and it's still in it at 8. There's no trend to continue and nothing to change character from, so every gap you find is a gap inside a range, which is condition 1, failing quietly. 3. Friday afternoons. The move is real, the follow-through isn't, and I'd rather protect my week than decorate it. 4. And this is the one you'll ignore. The day after a bad day. Not because the market knows you lost. It doesn't, and it isn't thinking about you at all. Because you know. You'll take the gap that only passes 2 conditions. You'll move the stop below the low, and then below the next low. Nobody has ever traded their way out of a bad mood, and the setup you're forcing at 9 in the morning will still be there on Thursday. Your drill for the next 2 weeks. Costs nothing. No live money. Every morning at 8, screenshot the GBP USD 15-minute. Mark your breaks of structure and your change of character, if there is one. Then, drop to the 1 minute and log one line in a spreadsheet. Was there a change of character? Did the breaking leg leave a gap? Yes or no? And where would the entry, stop, and target have gone? That's it. 2 minutes a day. 10 sessions in, you have something more valuable than any video. Your own numbers. You'll know how often a gap actually shows up at your open. My honest guess is fewer days than you'd like, and you'll know how many of those passed all 3 filters. Then, and only then, you'll know whether this belongs in your trading at all. That's not me being modest. That's the only way anyone finds out anything in this game. Recap, and where to go next. 5 things. Structure is 2 questions. Is it breaking highs? And has it lost a higher low? A gap is 3 candles, and it marks the least traded area, not the most. 3 filters before you draw the box. It broke structure, it's untouched, it's in the right neighborhood. The order is entry at the midpoint, stop below the low, target at structure. And a close through the far side kills the gap, no negotiation. Next week, I'm doing the other half of this what to do when there's no gap at all, which is most days, and the continuation entry I use instead. Subscribe and turn the bell on so it actually reaches you, because these don't show up on their own. And drop a comment with a pair you're going to run the drill on. I read them, and it tells me what to build next. And the line I say at the end of every one of these, because it's true. None of this is financial advice. Trading carries real risk, and most retail accounts lose money. Your broker has to publish that number, so go and read it. Keep your risk between 1% and 2% per trade, and if a video ever makes that sound optional, close the video.